Hi friends, it's Alex, and in this video I'm going to be talking about the differences between Roth and traditional retirement accounts, as well as providing some examples of each for clarity. So first off, what is a retirement account? A retirement account is a tax-advantaged bank account that allows you to save and invest your money with special benefits or tax exemptions. The two types of retirement accounts are traditional and Roth. With a traditional account, you pay taxes later and save on taxes now. With a Roth account, you pay taxes up front and don't have to pay them later when you pull the money out. A traditional account lets you lower your taxable liability right now and pay taxes on that money later when you pull it out instead. A Roth account lets you grow your money tax-free because you pay taxes up front before you put it into the account. To illustrate the differences between these two accounts, I'm going to be going over 3 examples. One in which taxes are higher when you retire, one in which taxes are lower when you retire, and one where taxes are the same throughout your lifespan. Now, I'm not going to be talking about which account is better or what you should choose. One last thing before we jump into some examples. There are several types of retirement accounts you can have, and they come from different places. So an individual retirement account you can set up yourself. You might have heard of a 401k or a TSP account, and those are set up through your employer. Typically, employer-sponsored retirement accounts have matching contributions, which you should definitely take advantage of. So see your employer and your contract to find out what kind of matching contribution benefits you can get through your work. If you work in the nonprofit sector, then your retirement account is likely a 403b program. So starting off with our benchmark, you get a job and let's say you're making $50,000 a year. Let's say for all these examples, your tax rate is going to be 30% per year. You are going to try to save 20% of your take-home pay. So if you want to save as much money as you can on taxes right now, you're going to put your money into a traditional account. This can be a traditional IRA or just an average everyday 401k plan. This is because the money you put into a traditional account doesn't get taxed today, and you can reduce your taxable liability. So it'll look something like this. You get your $50,000 a year paycheck, you put away 20% of that for your savings, and then you only have to pay tax on the remaining $40,000. So that 30% tax rate only affects the $40,000 that you still have out of your retirement account. The catch, however, is once your saving account and investments have grown, you will have to pay tax on them when you pull them out at retirement. We will come back to this later. But let's say instead you don't mind paying taxes now, you just don't want to have to pay taxes later. You're then going to invest in a Roth retirement account. This can be a Roth IRA. Roth 401ks are not as common, but they do exist. Check with your employer to see if you have that option available to you. What this means is you will not get a tax write-off now. So you have your $50,000 annual salary. You pay your 30% tax rate on that, and then of that remaining value, you save 20%. But this time, your savings and investments will grow tax-free because you already paid tax on that money up front. So now that we have this all sorted out, let's look at our 3 examples. First, your taxes are higher when you retire. Second, your taxes are lower when you retire. And third, your taxes are exactly the same when you retire as they are today when you're saving your money. Just want to make a caveat. The chance of your taxes being the exact same when you retire as they are today is very, very unlikely because throughout your life, policy changes, governments change, and so taxes could go up and down with that change, as well as you personally will be later on in your career, you'll have made a lot more money, and you might be commanding a higher salary, which means you would be paying more taxes. So keep those 2 things in mind when considering taxes in the future. Let's say your investments net the average annual return of 7% per year over the 30-year career you are invested in the stock market. So in the traditional example, 20% of your $50,000 salary is $10,000, and you put that away to save it. But you'll still need to pay tax on this money when you pull it out. In the Roth example, 20% of your $35,000 is $7,000. So you have $7,000 in savings that are going to be growing in your investments, and you don't have to pay tax on this money. You already paid your $15,000 in taxes the year you received your paycheck. So over the 30-year period, here is how much both of your account savings balances will have grown to. Now, in case 1, where taxes are higher when you retire, let's say your taxes go from 30% to 60%. In the traditional account, you still have to pay tax money. So you're going to pull that money out. And when you do, you have to pay 60% of what you pull out in taxes because it's a taxable withdrawal. Because of this, you'll end up paying about $45,673 in taxes. And you get to keep $30,449 or so. Now with the Roth account, you already paid taxes. So when you withdraw your money, that is not taxed at all, which means you get to keep all $53,285. So here you can see, because taxes were higher when you went into retirement, you ended up saving more money by having a Roth account. But what about if taxes are lower when you go into retirement? Let's look at case 2. Let's say now your taxes are lowered by 20%. So you're only paying 10% taxes on your money in the retirement account. So this time your $76,122 is taxed at a 10% rate, which means you're only paying about $7,600 in taxes. And you get to keep almost $69,000. Now with the Roth account, we already paid taxes up front, so you get to keep all $53,000. As you can see in this case, because your taxes were lower in retirement, you got to keep more of your money by having a traditional account. Now lastly, what about if your taxes stayed the same throughout your working life? Well, with the same level of tax, you'd pay 30% on your withdrawals from your traditional account. Your Roth account, however, already had its taxes paid, so you get to keep that $53,000 without having to pay anything. And with your traditional, 30% of your $76,000 comes out to $22,836. As you can see, the amount you'd save from both accounts is exactly the same. So if your taxes are going to be the same, then both accounts are virtually identical. In one example, you end up paying a lot more in taxes, but you get to keep the same amount. In the other example, you pay a lot less in taxes, but you get to keep the same amount. So really, the difference in retirement accounts is about when you want to pay taxes. Do you want to pay them today because you're worried taxes might be higher in the future? Or do you want to pay them later when you take your money out because you think taxes might be lower in the future? To answer that question, I recommend you talk to a financial advisor. Ask for a fiduciary, and if you want a detailed explanation of that, see my video on what to ask a financial advisor. So effectively, the purpose of a retirement account is to shift when you want to pay your taxes. Do you want to do it later, or do you want to do it now? So that's it for this video. I hope that clears things up. If you want to learn more about finance or want to keep in touch, my social media handles are on the screen now. You can find me almost anywhere on the internet, and I try to post useful, helpful information on all of my platforms. I focus a lot on financial literacy, so check out my financial literacy playlist if you want to learn more and have a better understanding of finance. If you have any other questions about retirement accounts or any finance-related topics, please leave them in the comments so I can respond and maybe make another video about that. Thank you so much for watching. I will see you next.